Good afternoon, everyone, and welcome to the Regional Differences in Risk and Return panel. I'm joined by three experts to my left. Clearly, it's a very broad topic for discussion. But what we're going to try to do is highlight some of the differences. Sorry, I need the click.
You had a slide.
I do, right? Yeah.
Carl, do you have a slide for? There it is.
Some of the differences in returns that are available across the debt stack between Europe and the US, but also to look at some of the factors that impact the differences in returns, both available both across between the Europe and the US, but also across some of those European markets. And we'll also explore some of the drivers with Sascha on the institutional side in terms of debt versus equity investment decisions in the current market. So we've put a slide behind, but I think the good starting point is to just talk about the returns that are available across the different parts of the capital stack. And perhaps Jeff and Patrick, you could just talk through where you see returns and those in the whole loan, the MERS, and the senior space, and what's really driving those returns and the components to those returns.
Sure, I'll start for the U.S. We've seen, you've seen some of the presenters earlier already speak about it, but we've had a significant change in borrowing rates and return profile since the beginning of the year, which has been a pretty big impact to the equity markets or the direct acquisition markets. The primary issue is that the senior lender space has become very thin. The securitization markets have had trouble placing a lot of the senior debt via CMBS, AAA through BB, single B. So the senior lending market has shrunk in terms of LTV and in terms of like the ability to meet the needs of a lot of the acquisitions that are going on. So we're now seeing whole loan rates that are climbing up to, what are the numbers? I can't see them, but we've got numbers that are climbing into the, I would say if we looked back at the beginning of the year, the whole loan rates would have been 3 to 4%. We're now into the 6 to 7% range. And as folks mentioned earlier, that's really attributed to 230 basis points increase in benchmark rates, another 130 to 150 basis points of spread premium, plus the forward curve being steeper. So take that into account. We've got 300 to 400 basis points more of returns just coming from a whole loan. On the MES side, where you're seeing senior